Welcome, everyone, to a podcast discussing the important points covered in the PowerPoint slides for Chapter 3, specifically income inclusions. Remember, the general rule is that all income is included except if it is specifically excluded under the tax law. So that's our general rule. So that's what we'll go with. So we face two problems: making sure that we see those income items, what they are, and then remembering those items that are specifically excluded under the law. So it can come in any form. So someone pays you in jelly beans, it's still income. Example here is we provide tax or legal advice, return for a used car. Gross income is a fair market value of that used car. Does not need cash. So that fair market value is what you would expect to sell it for, and that assumes that everybody knows the actual condition of the car. There's nothing hidden in the transaction. If you have an item that you receive and then sell it, that would probably be the fair market value, assuming that what you sold it for, assuming that it's an arm's length transaction. But you could also use some way to estimate that, an appraisal, or for cars, we have pretty well established values in Kelley Blue Book that could be used. So that's just to establish the principle that trading or bartering or using something other than cash does not make something excluded for income. So accrual versus cash. Now most taxpayers are cash basis, but some businesses are accrual basis taxpayers, which means we learned in Accounting 101, they record income when it is earned, not when it is received. However, if you get cash in advance, what we would call unearned revenue, if we were thinking about it from an accounting standpoint, under accrual basis, you would record that or report that on your taxes as income in the year that you earned it up to the second year, over 2 years, but not any later than that. So here's a 5-year warranty, which is recognized as income 7 months out of the 60 months in year 1, and the rest in year 2. Cannot go past year 2. So even though you're going to then provide services for another 3 years, you actually have recorded the income. So it really isn't true accrual accounting as we learned it in Accounting 101. So cash basis, the thing that you need to be careful of is what's called constructive receipt if it's made available. So if someone sends you a check and you receive it but do not take it to the bank, it is still received as cash. That's constructive receipt. Example they give is that if you have money in the bank and it earns interest, that is credited to your account usually at the last day of the month. It does not matter that you did not did not pull that money out until next year. It is still income in the year that it was credited to your account. So compensation for employees takes a lot of different forms, all of which are included in income. A little bit about tips, kind of an odd situation, a little bit different than some of the other examples. If it's less than $20 during the month, so it happened maybe once or twice is all, you don't have to tell your employer. It's still income though, still put it on your tax return, but you don't have to pay your Social Security taxes. If it's more than they tell the employer, you are required to tell your employer, report them to the employer. They have to treat it as additional wages and withhold the taxes, both income taxes and FICA taxes. There's a form for this in order to tell employer about it. In fact, there's a credit for employers for the part that they match, just to incentivize, because everybody knows that this is a hard thing to actually enforce. In large situations or large restaurants, they've gotten to just estimating at 8%, given that that's kind of the, or averaging together the credit card tips in order to find that, because cash tips are so difficult to track. Now, another element of income that might be forgotten or not thought about is what happens at a divorce. There are three things that happen in a divorce in terms of money, three types of payments. And first is division of property. Probably said that is non-taxable, meaning if you divide up the house, or some, for instance, one spouse gets the house, the other spouse gets the cabin, that division of property is a non-taxable transaction. It is not income to either one receiving that. But alimony, or spousal support, as it's called in the tax law, is income to the recipient and deductible to the payer. However, child support is not. All right, so it's important to determine how much is alimony and how much is child support. So one of the things that people might do is they put into the agreement, call it alimony so they can deduct it, but really it's child support because it changes when the child is expected to be on their own. That's child support, not alimony. Alimony is for the spouse, not for the support of the children. And alimony must end at the death of the receiving spouse. That's a requirement to qualify as alimony and be deductible. So if you pay less than what you're supposed to, which is way too often the case, if the spouse that's ordered to pay pays less than they're supposed to, it applies first to child support, and then only then the rest of it is alimony. So if you pay all of it, like this example, as shown as ordered, then the child support is simply the $800 as the agreement states. The rest is alimony, which of course is deductible and taxable, depending on whether you're paying it or receiving it. However, in this case, where you were supposed to pay $3,000, someone was supposed to pay $3,000 a month, and they only paid $30,000 more instead of $36,000, then you first take out the $12,000 that should have been for child support, and only then is the rest of it is alimony. Okay. Now, IRA distributions. Now, first principle is with IRA distributions, by and large, almost every time they are taxable, because most people put it in as a tax-deductible IRA contribution, which means they did not pay taxes on their contribution, and therefore they have to pay tax when they pull it out. Now, sometimes, based on various rules, they may have made a mistake and put in something that ended up being non-deductible. All right, so they had some non-deductible contribution. That means that some part of what you pull out is non-taxable, and we use this formula to figure out the amount. But remember, the rule is IRA distributions, unless this is the case, are income. Pensions, same thing. Most pensions, almost all pensions, are taxable when you pull them out because you got a deduction. You didn't pay tax on the money when you put it in. But if you made after-tax contributions, then you would divide it by the number of expected monthly payment to get how much you don't include in income, the exclusion amount. All right, so usually it's the rest of your life, and the IRS being the generous folks that they are, can tell you exactly how long you're going to live. Well, they estimate. And so based on your age, you're going to take the amount and divide it by these factors. So here's an example. Contributed $86,800 with after-tax dollars. All right, and most of the time your pension provider would actually keep track of this and tell you how much that is. But you divide that by the 310, and you exclude 280 from your income. So you receive $12,000, but only pay tax, or only be taxed on 10,800. All right. Now, in this case, this is a joint couple, and that pension is going to include both of their lives. So we have a different table for joint life expectancy that tells you how much to divide that amount by. And so you take the 97,920 and divide by 360 and exclude 272 out of each payment. So for each payment, you would include the rest, but exclude the 272, which is basically a return of money you put in after tax. Now, annuities work a little different. Same principle. You're figuring out how much is excluded, but this way we're going to do it kind of as a percentage. We're going to take the amount we paid for the annuity and divide it by the total expected return and get a percentage. All right. Now, if the annuity is a term annuity, it means it's going to pay for a certain amount of time. You would know exactly what that would be. You take the amount you're going to receive times the number of payments, and that would be your total expected return. If it's going to last for your lifetime, then we have the IRS again estimating our life expectancy, and it's computed using those tables. You take the amount you're going to receive, multiply by your life expectancy, and then take that percentage and you multiply by the amount received for a particular year, and that gets you the exclusion. Then the rest of how much you receive is your included income. So, Social Security. This is way more complicated than it should be, but it is the way the law is written. Okay, you can either pay tax on 50 or 85, 0, or part of your Social Security benefits depending on your income. The most you can pay is 85%. The most you would include in your income, I should say, is 85%. So no matter how rich you are, 15% of your Social Security benefits will be excluded from your income. So there is a kind of a calculation, there is a worksheet to do this, calculate this. There are some examples in your textbook on do this, but basically if your income, your adjusted income. So first of all, you need to adjust your income by adding back 50% of your Social Security benefits, so your AGI and all your other income, plus 50% of your Social Security benefits, plus your tax-exempt interest. Now remember, tax-exempt interest is not included in your income, but for this pretend calculation, you have to add it back. Okay? Now, if that amount is less than $25,000, if you are single, then or head of household, then you don't pay tax on any of your Social Security benefits, not included. If it's less than $32,000, if you're married filing jointly, then you don't pay on any of it. Okay. If it's between 25 and 34, or between 32 and 44, then you're going to pay probably on about 50% of the amount of the income over the threshold, or 50% of your Social Security benefits, whichever is higher. If you exceed 44 for married filing jointly, or 34 for everyone else, then you're going to potentially pay on up to 85%. So that's roughly how it plays out, how these worksheets work. So kind of think it through in those terms to make sure that your result makes sense.